Hey everybody, it's Tuesday, the 4th of December, 2018, and the markets got hit pretty hard here today, down 3+%, 3% for the SPY, close to 3.5% for the Russell 2000. Let's take a look here. We've got this market, as I said yesterday, it looked like we were probably in a bigger range here, and this is a really big range. Today we came down and tried to stabilize near the midpoint of that range, and you can see, of course, we did not hold in there. I drew in these volume weighted average price levels from all these recent peaks and valleys, and you can see that they kind of came together right around in this area, but were unable to hold. All we know when we're heading down is that becomes a level of interest to say, okay, if you shorted or if you are, on the sidelines looking for a place to purchase, you look in that general area. Similar to the rising 5-day moving average. We look at it, we say the intermediate term trend, we want to give the benefit of the doubt to the buyers with a rising 5-day moving average. But when it gets there, it does not mean stick a bid in. It means observe it on a shorter term time frame for evidence the buyers are gaining control. There was zero evidence that the buyers were gaining control in there. Now, when we look at the volume weighted average price off of this gap and then this low here, you can see we're the more relevant one for a hopeful perspective, I guess, would be right there. As far as the Fibonacci of this recent move goes, we're pretty much down to a 61.8% retracement of the lows from late last month to the highs we've seen so far this month. And if it doesn't hold in here, then it's most likely to continue down towards the bottom end of this range. As we know, we have a declining 50 and a declining 200-day moving average, and we're back again below the year-to-date volume weighted average price. We don't trust rallies when we have a declining 50-day moving average here, and we've got a lot of time frame indecision still. No one said that this is easy. In fact, bearish environments like the one we're in tend to be much more difficult. Over a course of a couple days, they'll rally significantly and you'll feel like you missed out. And this is why, again, we don't short after a big move and we don't get long after a big move. The NASDAQ, for this case, it came right up to that trend line we had observed yesterday in the declining 50-day moving average, which is where we see the 200-day moving average. And now you can see, you can call that a bearish cross. A bearish cross is not a timing signal. It's simply a marketing term. It's typically bearish for markets, but it doesn't mean we will continue bearish. That not by that itself, but by the fact that we still have lower highs and lower lows. It just confirms that we have a downtrend in this market. These are our lower highs. These are now the lower low, the lower low rather. So, I'm sorry. These are the lower highs, and of course these being the lower lows. The Russell 2000 also, we came back down off that declining 50-day moving average, and it just looks terrible from pretty much any time perspective you look at. We've been holding on that volume weighted average price from the IPO. That gives up, and then it looks like this is the next level. Let's take a look at those on the S&P 500 as well. Here's the volume weighted average price. Actually, the one that we've been looking at that's been holding is off of that February 2017 high, and below that, if we get, the more times any type of support is tested, the more likely it is to fail. If we come down into this, I'm sorry, let me take it back to that daily time frame. If we come back down, bounce off of it one more time and then fail, I think you've got a pretty quick move down to the volume weighted average price from the election. For the NASDAQ, we came very close to that last week, and a test of it seems likely. Semiconductors, they continue, as we know, on the weekly time frame to show we have a declining 10, 20, 30, 40 week moving average. That's a bearish environment. Prior support broken, acted as support, is resistance in here, and it's not meant as an exact precise level, but you add up the sum of it with a declining 50-day moving average. Now we're back below a 20-day moving average. The market is just not behaving well, and we don't expect it to. We spoke about the potential for an inverted head and shoulders pattern, that if we had the possibility the market would rally, that it would try to hold in here. Well, there was zero evidence of it trying to hold in that level here today. So, that scenario is pretty much out the window at this point. So we can just clean all that up and stop looking at such a mess and projecting patterns. Instead, we look at it and say, we've got a failed move here. The biotechs, they've had a nice run recently, as we know. They came right up to where they were supposed to come up to. That is the conjunction of the 50 to 200 and the year-to-date volume-weighted average price. And now it's not really a surprise to see them backing off. It doesn't mean that there was an obvious low-risk short entry, but it does mean that if you had purchased into that break of levels last week, that you look at this market and say, hey, it's measured out to where it's supposed to go. Time to raise your caution overall once again. Financials, this group broke down below the prior low from last week. So in 2 days, it took out all that, so-called positive action in here. And again, declining 50-day moving average. We spoke about the possibility it could get up to the 200-day moving average in the year-to-date volume-weighted average price, and it failed perfectly in there. And now there is zero evidence the buyers are coming back into control in here. Are we going to see another one of these events where the people who blindly bought into the pullback get some luck and see an open higher on Thursday when the markets reopen after the day off? I don't think so. I think that the more times you see these rallies fail, the weaker it makes the overall psychology and thus holding period of the people involved. The energy names are coming back down. They did not hold that 20-day moving average. These markets remain in downtrends, and we have to be wary of those bounces and have risk management always as our number one job.